Let's take a look at how the covered call strategy works. A covered call consists of buying 100 shares of stock and selling a one-call option on that same stock. Let's say we have a company, XYZ, that is selling for $85 a share. We see that with our covered call, we will pay the $85 for each of the 100 shares that we buy. But we also collect $4 per share for the option we sell. So how much does this covered call cost us? We see that this covered call is only going to cost us $81, rather than the $85 it would cost to buy the stock alone, because we are collecting $4 for selling the call option. This means our investment would be $8,100 instead of the $8,500 required to buy 100 shares of the stock. If the stock were to drop $4 in price, owning the stock would give us a $400 loss. But on the covered call, we would have no loss. We refer to this as having downside protection. In this case, our downside protection is $4, so the stock could drop nearly 5% without hurting us. Do we always buy a covered call for $4 less than the stock price? Of course not. With any option, there are a few details we need to provide that will establish our profit potential and the degree of downside protection we have. So let's see these option details. We see that we sold an option that the buyer can use for the next 2 months, and then the option expires. All options have an expiration date associated with them. We also see that the option has an 85 strike price. In this case, that happens to be the same price as the stock, but that is not always the case. What is a strike price? The 85 strike price gives the options buyer the right to buy our XYZ stock for $85 at any time before the option expires. Strike prices always work this way. They give the option buyer the right to buy a stock at a certain specified price until the option expires. Where do you stand as the option seller? Let's summarize our covered call trade like this. Buy 1 September XYZ covered call with an 85 strike for a net cost of $81. Let's look now at your target profit as the seller of this covered call. We see that your target profit is $4 or $400 on the $8,100 you invested. This represents a 5% return on your investment. But that is not 5% in a year. It is 5% in just 2 months. So when we annualize this return, we see that this corresponds to a 30% return in 1 year, if we repeated this trade every 2 months for 1 year. While we may not have the opportunity to do the XYZ trade every 2 months, there are plenty of other opportunities that will provide similar sorts of returns if you know where to look for them. So, is this guaranteed money? Not quite. Let's look at what happens in 2 months when the option expires. XYZ could be above the price when we entered, below, or unchanged. We see some sample values of XYZ here. So if we own the stock by itself, we would have no gain if the stock price of XYZ is unchanged, and a $100 profit or loss for each point the stock moved. So if the stock moved down to 80, we would have a $500 loss. Or if it moved up to 90, we would have a $500 gain. Now, what if we owned the covered call we've been talking about instead of just owning the stock? First, we notice that if the stock went nowhere, we have still made our maximum profit of $400. Nice. It's great to be able to make money when the market does nothing, which is a high percent of the time. And if the stock dropped 5 points, we have lost only $100, rather than the $500 loss we would have owning the stock. So we see our downside protection at work. We do see that if the stock moved up to 90, we would have made $100 less than simply owning the stock. But for any drop in price in XYZ, we are in better shape with the covered call than with the stock-only position. And If the stock rises, we are still ahead with the covered call until we get up to $89 and more. So we have a much greater chance for profits with our covered call than with our stock-only position. This is the beauty of covered calls. As long as the stock stays above the strike price of the option that you sold, you need to do nothing whatsoever to realize your maximum profits. We call that the magic green line. And so long as the stock stays above what our net cost was, we have no loss. So that is the stock price that represents our break even on the covered call that we entered. We sometimes designate that with the magenta line. So how do I close this position and book my profits if the stock goes my way? And what do I do if the position goes against me? We cover those topics in our video, Managing Your Position, as well as in our blog posts and members-only workshops.